So the last couple of years have been quite tough for many investors. Now, I've also had quite a few hard hits and I've taken a few punches. So I just wanted to recap a couple of the key lessons that I've learned. Stick with me till the end because I'm also going to tell you what I'm doing differently in 2024. So first off, dividend investing and some of the key lessons learned. Every situation is going to be different. There's a couple of key principles that it's always important to keep in mind. I don't get everything right, like many good investors, and I'm constantly learning. So one of the key lessons that I've learned over the last couple of years has been the Medical Properties Trust. Now, very early on, this looked like a good solid compounder, and I started taking a position just as it slipped off the highs, which is a terrible time to start investing in an opportunity. Now, I managed to cover some of my costs and mitigate some of the losses by selling options. It's not a strategy I'd recommend for all people all of the time, but it worked well for me in this circumstances. So what is the lesson here for me? Well, I looked at the opportunity closely and I thought this was a nice opportunity. It seemed to be doing well and it seemed to be paying dividends and it seemed to fundamentally be able to increase the dividends and it seemed to be a safe and secure stock. And goodness gracious me, we all need hospitals. Now, Medical Properties Trust is a REIT. It owns and allows people to use those hospitals. And of course, the tenants using the hospital pay a Medical Property Trust revenue, rent, which then turns into revenue for Medical Properties Trust, which it returns to me as a shareholder. Now, it worked well to a point. Now, I ignored several warning signs. So what did I learn from this? Number one, tenant concentration, a customer concentration risk. They have two major tenants which represent a very large proportion of their cash flow. Now, they're not alone, and it's not necessarily bad per se. When things are going well for the company and their tenants or their customers, things are going really well for me as a shareholder. Now, the problem was that the tenants soon hit some financial difficulties coming out of COVID. This by itself is perhaps not surprising. However, there were some peculiar loans from Medical Property Trust to their largest tenant, Steward Healthcare, to try and keep them on their feet, to try and help them out of a bad patch. And I think I understand why the management team did this, but I wish they hadn't. So, two things there. Number one, concentration risk from the customers, and then number two, some peculiar practices there that I probably overlooked, and in hindsight I regret overlooking these practices. I wish I'd paid more attention and been more careful with them. I also have some issues around, I think, the way in which the management team went about describing the level of risk that their tenants were facing and the level of difficulties and problems that the tenants were having. I think they could have been more forthright, and hindsight here, my friends, is 2020. So it's not always going to look like that all of the time. What else? Well, another big lesson that comes to mind is probably New York Community Bank, NYCB. Now, NYCB is one of the opportunities here and had a couple of positions in smaller regional US banks over the last couple of years. I've exited all of those positions. Now, one of the things that I've learned about the banking sector, and yes, you could say, Lincoln, you're an idiot for not realizing this, but of course, banks are heavily regulated, and if the regulations change, the opportunities for the bank and their profitability can be very shaken and very quickly. So, following the Silicon Valley Bank bust up, NYCB did, I thought, a good job of cleaning up and doing well. But very quickly, they lost a lot of the confidence from their investors and from their regulators, and some changes there meant that essentially it wasn't going to be as profitable for them as I thought it was going to be. And even though I thought they had, on the face of it, a stable, secure, safe portfolio, the changes were disadvantageous. I think the changes from the regulators hurt the bank more than I thought they would. And my lesson here for me is that when a market and the businesses are heavily regulated, these small sets of changes can actually make an investment opportunity substantially less attractive. And again, you can say, Lincoln, you should have realized this, but it's certainly something that I'll be running my eye over the next time I look at some investment opportunities. And as I said, I've sold out of the regional banks that I've been a shareholder in the past. Other key lessons. One of the other final key lessons is going back a little ways, but looking at the COVID crash. Now, yes, it's a 1 in 100 year event, but a 1 in 100 year event does happen, and big cataclysmic issues can crop up, and that can substantially and seriously hurt our investments. So what did I learn from this? Well, I learned that the balance sheet and the assets and conservative style of management is one that's going to help me to sleep well as a shareholder in the companies that I invest in. So I want less highly leveraged companies that are less reliant on debt. So one of the big companies here that helped teach me this lesson is undoubtedly Algonquin Power. Now, in this particular case, I was somewhat bullish and still buying right where their debt-fueled growth plans started to come unstuck. And again, I got slammed with a fairly substantial decrease in the share price. Again, was this foreseeable? Potentially, yes. But again, I was not paying enough attention to the conservative management of the balance sheet and the conservative management of the debt in the companies that I was investing in. Not as much as I think I should have, and that's also something that I've been turning the corner on here in 2024 now. Now, a final lesson is perhaps one that goes back even further, and to the very rapid and very volatile swings that we can see in the market, such as the 2020 pandemic flash crash. So what is the problem? Well, the problem is, even if an asset looks stable and even if the prices do not change very much, you can be lulled into a false sense of security. I'm thinking particularly about baby bonds and about preferred shares. Now, I'd normally assume that these would trade at about their par value of about $25, but we can see that with a substantial economic uncertainty such as the COVID crash, even stable prices can fluctuate wildly, and this can be incredibly alarming. And so I've run a ruler over many of the other investment opportunities as well, and this is also something that I have been thinking about much more seriously, and that's also been leading me to reevaluate the portfolio positioning and the role of hedging or inversely correlated assets and investments as a big part of my family portfolio, and that's going to be something that I'll be continuing to invest in also for 2024, and I'll cover that in more detail later. So look, this has been helpful for you. The next video I think you should watch is one focusing on dividend safety and making sure that you know how to look for the telltale signs of a dividend in trouble versus a company that's going to keep on paying that dividend for a long time. So my friends, let's get into it.